Alibaba dropped more than 10% after announcing their Q3 earnings. And oh gosh, this is giving me such a headache. But as a believer in Alibaba and its long term growth prospects, I will be buying the dip on Alibaba stock. This is an in depth analysis of BABA. Welcome back to another video. My name is Adam. On this channel, I talk about investments, my portfolio, cryptocurrencies, stocks, how to save money, etc. So if you enjoy all those things, feel free to subscribe to the channel. And of course, hit the thumbs up button. I've been talking about Alibaba since I've bought it, and I've accumulated it to one of my largest positions by what I bought it at so far. So this is just want to be fully transparent. In my main account, I have 10 shares. Cost basis was $241, down about 41% or around 1,000 US dollars there. So yeah, definitely hurts. And in my other account, my Wealthsimple account, I have only 4 shares, but I will be buying the dip, down 25% there. And again, I think like Alibaba is close to its 52-week low at like $139. And we know prominent names in the business such as Charlie Munger. His Investors Daily, that company basically just bought more shares as Alibaba continued to dip. And I'm assuming that he's just going to basically double down on his position again as Alibaba is like $140 per share. I'm actually waiting to buy more shares just because after a big down day after they reported earnings, I mean, this stock fell by like, more than 10%. Basically, you don't want to catch a falling knife. So I'm going to wait 1 or 2 more days after this. So maybe Tuesday, I'll start to accumulate like 1 or 2 more shares. I don't have a lot of money available right now, but I might transfer some in just to buy more shares of Alibaba at like such a discount prices. So I have 14 shares in total. I know that doesn't sound like a lot, but to me it is a lot as a broke graduate student. And I just like talking about making money. So, in order to become rich, you basically have to act like you're broke. And broke people stay broke by acting like they're rich. That's basically my motto. But any basically penny that I have available to me, I'm going to be investing in stocks basically. So yeah, if you're into that, again, feel free to check out the Discord link as well. It's just in the description of the video. Check out my other social media channels as well to follow my journey. Anyways, so right now, Alibaba has a market cap of 424 billion. By the way, since its peak, it's down by about, year to date, it's down by about 48%. And since its peak, when it reached $310-ish, it is down by 54%. So it lost over half of its market value. It's still up by about 50% since it debuted on the New York Stock Exchange in 2014. So I mean, since 2014, it only gained like 50%. That is definitely not a good look. But I mean, I do believe in buying the dip, and I will be buying the dip on Alibaba just because still headline growth is really good, as we'll see in a second. Although if you take a look under the hood, there are some concerning things, especially with China's tech lash. Yeah, let's just take a closer look here. So anyways, right now, PE ratio sitting at 16, which is incredibly cheap for a company like Alibaba. Forward P of 18, still cheap considering that they're doing double-digit growth. So what I mean by that is analysts are expecting for the current year, for next year, 2022, to have 26% revenue growth. Next year, 2023, to do 18% revenue growth. So double-digit growth, having a forward price to earnings ratio of, 18 is just ridiculously low in my humble opinion. You look at something like Amazon, that price to earnings ratio is at least like a 40 or a 50. Forward PE is like a 40, I think, and 46 analysts covering it. And if you look at the average recommendation rating, it's between a buy and a strong buy with more than a 50% upside. The current price is $140. Average analyst estimate is $235 there. So more than a 50% upside here on the stock price. And I mean, I just believe this move is unwarranted. Alibaba has been beaten down like an absolute dog. Sure, the trend might continue. But again, if you just want to just look at technicals for a second, where we are right now here, we're going to look at everything. Technicals, obviously the third quarter results, we're right here, okay? And I mean, when these candles are below the lower band, the lower Bollinger Band, to me that's a screaming buy, especially when a company has a lot of cash on hand, is growing pretty nicely, even despite like the tech lash, that China is imposing. Okay, and I believe it's in China's best interest and in Zai's best interest to let companies like Alibaba still grow at a profitable rate and be sort of like one of the darlings of the Chinese economy, okay? That they're able to compete with something like Amazon. So I don't think they fully want to destroy and eliminate Alibaba. And again, if you want to go bargain hunting, like, what better than to see a stock at its 52-week low? We will talk about the downside pressure as well, though. As an investor, you always have to take into consideration both sides. So if you don't want to watch the full video, this is basically the highlight. I really like this by Billy Durbinstein. I like the Motley Fool just going on looking at articles because they tend to have a pretty fair viewpoint of companies. So yeah, Alibaba stock fell more than 10%. Headline growth looked okay, but there were larger problems. The core business is under pressure and newer ventures face an uncertain future. So shareholders to not get too overwhelmed, et cetera, et cetera. And famous investors like Charlie Munger are doing so. So don't blindly buy the stock is basically what this paragraph is saying. So they released the Q3 results on November 18th and the stock plunged over 10%. Some figures did seem to confirm the worst of Alibaba's business fears. So the biggest fear I had amid the China's regulatory crackdown wasn't necessarily punishing fines or the seizure of Alibaba's business. For example, they discarded Ant Group's IPO. And I mean, when you discard a huge business, that was basically the financial technology side, the fintech side of Alibaba's business. And Alibaba owns about 30% of Ant Group. And the regulators basically did not like what Jack Ma was saying in terms of how being like the Chinese banks were like basically pawnbrokers. And so they axed the Ant Group just like a day before it was supposed to IPO. China's intention seems to be level the playing field among businesses and come and increase what's called like common prosperity and sustainable growth, basically, which is good. But I mean, with Alibaba, like all the key competitive advantage that Alibaba has in terms of it being the biggest e-commerce platform in China, it's all slowly sort of going away. New regulation could eat away at Alibaba's competitive advantage. Although Alibaba is far away the leader in Chinese e-commerce, it also has very formidable competitors such as JD.com, Pinduoduo, and others. New regulations aimed at forbidding exclusivity on platforms and other monopolistic tactics stood to perhaps hurt Alibaba more than competitors. And that renewed competitive pressure is showing. Alibaba posted what looked like solid 29% overall revenue growth and 33% e-commerce growth, but excluding the acquisition of Sun Art Retail last year, overall organic growth was only 16%. Diving into different segments of Alibaba's e-commerce empire, the only real profitable segment is customer management, which is essentially online ad revenue from merchants on Alibaba's platform. That segment only grew 3% in the third quarter. So while some would attribute that to difficult yearly comparisons in the Chinese economy, even Alibaba acknowledged that competitive pressure played a part, saying this slowdown resulted from slowing market conditions and more players in the China e-commerce market. So low growth in Alibaba's most profitable division led to a big 32% in the company's adjusted earnings before interest, taxes, and amortization. That's because basically all of Alibaba's other divisions currently make losses with uncertain payoff. Yet even absent those strategic investments, commerce adjusted EBITDA in the core business was only flat year over year. So it appears that even the key cash producing core business is feeling margin pressure, which means for every dollar in revenue, more of that is going into like operating costs and administrative expenses. Is there any good news? While the main story on Alibaba's September quarter was definitely negative, there were a few silver linings. The company's cloud computing platform, which I said this before, that I was super bullish, and this may even become one of their key growth business in addition to e-commerce, right? That revenue grew 33% from quarter to quarter over the last year. And as investors in the US cloud companies know, it can be a very lucrative business. So that acceleration was good to see. And that is why I am so pumped. They even have their own chip that is efficient, cost effective, and that they use in-house in their data platforms. However, the cloud business is still unprofitable, but that's fine with me. They're still expanding, although it is slightly profitable on EBITDA basis. and only makes up 10% of revenue. So success requires some faith, etc. And I do believe that as they grow, especially their cloud computing segment, that their revenue will just increase. So Alibaba's stock does seem rather cheap at current levels. Despite this being a challenging quarter, Alibaba still made 3.5 billion in free cash flow, even in a down quarter that saw that figure cut nearly in half. Alibaba also has 68.8 billion in cash and equivalents on the balance sheet against debt in the low 20 billion range. So they could easily pay off their debt and still be left with about 50 million on hand, with another 38 billion or so investments and other equity. So oh my goodness, that's just great. So Alibaba's current market cap of 400 billion seems reasonable, even if its profit growth doesn't bounce back to prior growth rates. The company also continues to repurchase stock, buying back over 5 billion in stock just the last quarter. This is what I really like to see. It's basically a form of a dividend when the company buys back stock, because it basically condenses shareholder value. And when that happens, that's a really good sign for investors, because it means that the management thinks that their stock is cheap. So them buying 5 billion worth of stock, I mean, you can just do the math. How much is 5 billion over 400 billion in terms of market cap? I mean, we can quickly calculate this. And basically that's a dividend over the quarter of 1.2%, which is, compounded that times 4 quarters, that's a yearly quarter rate of 5%. So it's basically paying out a dividend of 5% year over year, which I like, even though the stock is just trading incredibly cheap, in my opinion, nearest 52-week lows. So since Alibaba's once high-flying stock is still down nearly 50% from its previous all-time highs, some may think it's a bargain. However, it seems like Alibaba is going to have to work harder for profitable growth going forward than it did prior to the regulatory overhaul. The company is still reasonably priced, et cetera, et cetera. There could be significant upside, but it will take faith and patience to realize that, and I'm a bigger fan of other Chinese stocks. So this guy, the owner, or the person who wrote the article, actually owns shares of Alibaba and JD.com. So I think overall Alibaba is a screaming buy. I think this is kind of a neutral sentiment towards Alibaba, but I think Alibaba is a buy just because they are increasing still, even though that the main e-commerce segment was flat. You look at something like China Singles Day. The gross merchandise revenue during the 11-day period, just search up what Singles Day if you don't know what that is, totaled $84.54 billion, a more than 8% jump from last year's Singles Day, which is a 11-day period. And to me, that's impressive, considering that Alibaba is taking into account a more social responsibility, and they're not trying to advertise it based on the increasing tech crackdown. So even with a muted advertising campaign around Singles Day, they did, both Alibaba and JD.com racked up around $139 billion of sales, which was the most ever for a Singles Day. So, I think when you're looking at China, sure, there's problem with the housing markets. Just look at the Evergrande crisis that's slowly unfolding there. There might be downward pressure there. That might put a little bit of strain on China's economy, but it's still one of the fastest growing economies on the planet. You look at the rise of China's middle class, that's going to be focusing and revolving and benefiting Alibaba. Sure, there's a tech down clamp, and whenever you make an investment, you have to look at the risk versus the reward. But I do believe that, considering the stock price is so incredibly cheap, only a 400 billion market cap, I think Alibaba has a long way. There's a lot of potential upside with this stock. So, I kind of agree with this article, although I am more bullish. I think that, sure, when you look at the segments, the only profitable segment was their commerce segment, which obviously is their key cash cow business. But I believe this cloud computing segment could be one of their top segments. Just look at the way that Amazon's cloud, AWS, took off, right? This could, 33% growth year over year is pretty impressive according to me. And we'll take a look more at their Q3 results here. So, do what you will, but I think Alibaba is a screaming buy. So income from operations for their commerce segment was 25 billion. If you consolidate that, it was, or not billion dollars, this is in won. It was about 15 billion won. When you take into account their other loss-making segments right now, which is cloud computing, digital media, innovation initiatives, and others, unallocated, etc. And you also have to consider that they bought back $5 billion worth of their own stock. So they still had a positive income from operations. This is just the 6 month ended here. And you look at everything else here, like basically I want to go all the way to the up here. That's all you need to know basically for their net income. But their revenue increased 29% year over year. But if you exclude the Sunart acquisition, it only increased 16% year over year, which is still decent growth, especially since we see China's regulatory crackdown taking into effect on the bigger players such as Alibaba. China commerce was 30% year over year. But if you exclude Sunart acquisition, it was 14%. International commerce, which is also another key exciting segment, increased 34% year over year. So what they're saying is that sure, maybe their main business in China is not doing so well, even though it's double-digit growth of 14% if you exclude Sunart. Their international commerce section grew 34% year over year. So that is also another exciting segment that when you have a big company like Alibaba, it costs less just based off of economies of scale to ship products abroad, right? And especially as the supply chain woes subside, I believe that they could even be more profitable in their international commerce segment. So adjusted EBITDA was down 32% year over year, which is, it was primarily due to increased investments in key strategic areas that have exhibited robust growth in operations, as well as their support to merchants. So again, part of their initiative to increase common prosperity and as well as increase investments in their key strategic investments. So within commerce, that lead to an increase of profitability. Annual active consumers, still like 1.24 billion global annual active consumers. That's incredible. And they added 62 million annual active consumers on their like super app basically. So they're still growing tremendously. And I love seeing that. That is like incredibly good to see. And I mean, like just even though sure profitability was down, but them just being able to add 62 million new users is a plus side for me. And I mean, I think that like this shows that there is a need for companies like Alibaba still. And that no matter how far the China techlash goes, it's still going to be a profitable business. And I think a lot of this negative sentiment is already priced in. And there's just a lot of upside from here. But don't take my word for it. Do your own due diligence. And if you pause here, the China's commerce retail, so this is just the quarter results, increased 33%. Customer management increased 3%. Others increased 111%. So this is primarily generated by direct sales businesses comprising mainly Sunart, Tmall Supermarket, et cetera, et cetera. We started consolidating Sunart in October 2020. So this is really cool that they had a 111% increase in revenue there. China commerce wholesale increased 15%, international commerce retail 33%, logistics 20%, local consumer services 8%, others 66%. So cloud computing, again, I'm really liking this increase of 33%. Digital media and entertainment was flat, and innovation initiatives was 37%. So 29% year over year increase in revenue to 200 billion won. So cost of revenue increased from 54% to 63%. And I mean, obviously margins are thinning, which is not good. But again, I mean, I think that's kind of to be expected, especially with the techlash. And they also said that Alibaba said they were going to donate a lot of money to charitable causes, I think. And from 6 months, it went from 54 to 60%, 62%. So general and administrative expenses actually stayed flat. Marketing expenses increased a little bit. And product development expenses actually stayed flat as well. So that's kind of good to see. Just cost of revenue just generally increased. Also probably because of supply chain issues. And so you can just like read over here. So they're still a profitable company. And I mean, you look at China commerce and international commerce, you look at the revenue that generated, 351 million won for the 6 months ended September 30th, and 171 million won for the 3 months ended September 30th. So overall, if you include also China and international commerce, like look at the expansion potential for the international commerce, which is in that gray bar. Like that's huge. Okay, so it's still their e-commerce section is a cash cow. And I think segments such as cloud computing will drive profitability in the future, even though it's not profitable now. So if you're taking a long-term outlook, I believe Alibaba could be a huge buy. And again, I would check out Alibaba Investor Relations. This is how you find out about a company, and go through the slide and really fully try to understand it. And I mean, for example, here, Alibaba Cloud, their Yishian 710 chip, which I'm very excited about, our new in-house processor. So they built it themselves, delivers exceptional computing performance and energy efficiency, which will be deployed in our own data centers. And we open sourced our newly launched operating system, Analyst OS, and plan to invest 2 billion won in technology and services to our ecosystem. So I think, sure, it's not profitable, but I don't care about its profitability. I care about that growth. And 33% year-over-year growth in the quarter is impressive to me. So again, their main e-commerce section, I think the worst of it is over, and the stock price is already priced in. I mean, it's down by 54%, plus their e-commerce segment, or in the cloud computing segment, will just be a growth beast into the future. And I think that investors should be taking a second look at this stock. So let me know what you think. If you'd like to support me on Patreon, feel free to do so. Give me some more stock money to invest. But please feel free to give this video a thumbs up, subscribe to my channel, and check out all the socials down below, especially Discord. And if you're a Canadian investor and you want to invest with zero commission, check out my free Wealthsimple link down below, and you can get 2 free stocks. Peace, guys. Love you all. And until next time, I'll see you.